From time to time here on the show, we pull back from fundamentals and trying to make sense of people's behavior and their, the quirks of people just being people, and trying to get the gist of rhyme and reason and sashay our world into the realm of Fibonacci, MACD, moving average convergence, divergence, stochastics, heads and shoulders, and double tops. Graham Bibby, good friend of mine, is a technical analysis operative who's been on, this makes you sound like a CIA agent, a TA operative who's been on the show a lot and been a longtime friend. Emotion does get in the way, doesn't it? That's the problem. People try to assume that there's logic out there when half the time there isn't logic.
Yeah, I mean, to me, I look at technicals and charts not as so much a way to predict the future, but to analyze what's currently going on and what the smart money's doing. So, people are buying on dips and you're going to new higher prices. That's a positive trend for whatever reason. Yeah. And that most of the time keeps you out of trouble, keeps you out of declines like last year, and gets you in early to markets like this year.
But this, it's not, you often have to read between the lines though, right? It's not just staring you in the face. You have to make some assumptions, and you do go out on a limb sometimes.
But it's a big jigsaw puzzle. Like, for example, now, as you know, in February and March, we said load up 100% on equities because that trend had reversed. But right now, we see, after 3.5 to 4 months consolidation, that all the markets are breaking out to the upside. The commodity markets, the stock markets. And then you look at the matrix of things. You look at where the dollar trends might go, where gold, silver might go. And then you see things like transportation stocks like Federal Express, on a really significant upward move. That means goods are moving around the country. We see leisure stocks moving. We even see the old casino stocks all starting to rise again. So, that's positive.
All right. Graham, let me bring in our good friend Soon Hock, Chua Soon Hock from Asia Genesis AM in Singapore, a very highly regarded professional in the space. Soon Hock, how much time do you spend with your slide rule, with your HP12C and crunching these numbers and looking at the technicals? Do you do that, or do you really just concentrate on economic data, rollouts, jobs reports, first-time jobs claims, that sort of thing?
I look at charts every day. I study them in great details. My focus is more on the basic identification. Are we in the bull phase, bear phase, or range phase? And then I will try to break it down. Is it in the early part, mid part, or late part? I study the market psychology very closely to see, are they at the verge of a change in psychology?
And Graham, is there a change in psychology? Because your bets and your prescriptions now are quite different than when we were talking back in March, when you were saying you could pretty much bet the ranch, correct?
Yeah, but I think we're in that position again. When I came on last time, we were sort of trading sideways. Even, I think, in June there was a bit of a correction, so it could have been a peaking out of the market. Psychology is number one in the market. And then you look at the contrarian view as well. So, as you said, it's not completely straightforward. It's not black and white. You have to, through years of experience, analyze what's going on. So right now, if we saw hardly any money in money funds, for example, we will be looking to say, well, we could be coming somewhere near a peak because everyone's invested. But right now we still know that in the US there are record amounts of money not in the market. Most of the institutions, I believe, are still not in the market. They've missed this whole thing. They thought this might be a W, they thought this might be a correction back again, and it's not happening. So they're going to have to move in the market soon, or as any clients that they've got left, they're going to be losing.
Soon Hock, how reliable has your technique, studying psychology and balancing psychology against some very quantitative views of the markets, has it led to your success, or has it been at odds with using your heart versus your head sometimes when trying to make the big decisions?
No, you always have to use your head, not your heart. And I think the key is that a lot of time our expectations are wrong. So then I pay a lot of attention to what actually happened to the market and my expectation, and then be humble to admit that you are wrong and do something about it before you end up with big losses,
That's why humans run funds and not the machines. Otherwise, we could outsource it. Before you came on the program, Graham, I just want to get you to weigh in on some of the macro stuff that we've been talking about. Soonhawk is concerned about long-term structural implications of monetary policy and central bank actions. Inflation could go off into a fork, he was saying. You might have a low CPI, but you might have high inflation in certain asset classes. You saw the story about $25 million paid for an 800 square foot apartment in Hong Kong. Somebody got ripped off there, by the way. Okay, somebody got ripped off there. Do you share those concerns? Just want to establish the
what we've got to do, first of all, stagflation, deflation, inflation, but more like hyperinflation. You got to know the roadways, and then you move with it. Right now, we're seeing commodities break to the upside. They're improving on momentum, and then if we get this inflation or hyperinflation, then you move the portfolios to more commodity weighting.
Okay, and that's exactly what's going on right now. We're seeing that. It's almost like the market is picking up on this theme, unfortunately, before the secret.
Yeah, I mean, gold, I don't think is reacting so much to it because of the dollar's weakness, but certainly commodity prices and maybe silver. And if we get a chance after the break, maybe we can talk a little about uranium, which you know is one of my themes, and I can explain why we don't just follow the fundamentals.
Yeah. Okay. By the way, Larry just wrote in from New York with a question. Can you be more specific when you say asset inflation? Larry, we're talking about things like uber low interest rates. Like you can get money for 2% here on a revolving mortgage or an adjustable rate mortgage, which is in many ways responsible for, I'll just use my own Hong Kong apartment as an example, purchased 2.5 years ago at 8.5 million Hong Kong, or about 1.1 million US, now appraised at double that, okay? It's just the cheap money, kind of like acting with a steroid shot. More with our guests when AC continues.